We've had an amazing recovery in many different stocks, but I know many investors are still holding some cash. And some people ask me if you had to deploy this cash right now in some kind of a quality stock that's trading near its 52-week lows that hasn't really gone up yet, which kind of stocks would you be looking into? So I decided to talk about it in today's video and give you guys two stocks trading near their 52-week lows, pretty amazing companies, and they have yet to participate in this rally. So I really hope you enjoy it as always. The first one is Visa. Visa is still down about 8% year to date. It's down about 15-16% from its all-time high. I always say that Visa is actually the best hedge against inflation, and people get confused. But if you look back at 2021, 2022, when we had much higher inflation, Visa was growing earnings per share 15% and 24%. Well, this is because Visa collects a fixed transaction fee based on the ticket number. And let's say the ticket prices increase 10 or 15% because of inflation or maybe higher crude oil, like what people believe right now. Visa will collect 10 to 15% more without Visa having to raise this fee by a single basis point. So it's like an inflation indexed kind of a business model, a tool boost, you could say. Pretty amazing company, and it's trading at a much better valuation than where it was trading at before. Now, Visa always surprised me whenever I look at their earnings report, because this is like a $350 billion company, but they're still growing revenues 13% and about 14% in earnings per share. And it's been very, very consistent. I don't believe Visa has ever grown under 12% earnings per share in a single year. So they have an amazing business model. And again, if you look at other areas of their growth, they have other revenues, which is growing 33%, which is mainly services and some cybersecurity and the stable coins, I believe, and a few other things, which is really, really amazing. Now, Visa does have some risks in the short term that I have to talk about. The first one is mainly the dependence on the EU, and EU is highly dependent on Visa and MasterCard for their transactions. They're trying to move away or to diversify away from Visa and MasterCard, and they formed some kind of an entity to create their own digital payment system urgently. Now, they've been trying to do it for the last 10 or 15 years, but they're trying to ramp it up right now and try to, make it as quick as possible, and they're really trying hard to do it. Now, I don't believe they're going to get rid of Visa and MasterCard, but you're going to have additional competition. Now, for Visa, about 19.7% of their volumes comes from the EU. For MasterCard, I believe it's about 30%. So this is a big deal for those companies. And again, if people travel, they do other things, they will most likely be using Visa and MasterCard instead of using a local payment like they use in India. They're going to be using Visa and MasterCard. So I don't believe it's going to wipe out the 19% of revenues, but it could wipe out 2, 3, 4, 5, 6%, and that could potentially affect the company. The second one is the whole risk around stable coins, and that was mainly mentioned in the Citrini report, which some of you are familiar with. And this is like a thought process that, let's assume 5 or 10 years from now, you have the AI agents doing the shopping for us, and we tell the agent, go buy me a couch or buy me whatever. And the agent will look to settle the transaction for as cheap as possible. And if the agent wants to save on a lot of the fees that Visa and MasterCard are charging, he will most likely be doing it through stablecoins, therefore bypassing Visa and MasterCard. Now, Visa actually has an advantage over this, and Citrini mentioned it himself in the report, and they mainly have a really good stablecoin business. They were very, very early, and now the settlements have reached a $4.6 billion annualized run rate. Visa is ahead of MasterCard in this area, although MasterCard has spent a few $1 billion acquiring some kind of a stable coin railway company recently. So they're trying to get into it, but Visa clearly has an edge over here, and I don't believe stable coins will fully disrupt Visa. Now, if you look at Visa, it's again a really amazing business, about a 50% net income margin, very high return on invested capital. The free cash flow yield right now is trading at about 4%, which means you can own an amazing wide mode company like Visa for pretty much the yield that you could get if you're buying the 10 or 50, 10 or 20-year treasury, which, it doesn't happen very often. Normally, those companies, they are growing, they trade under the 10-year on a free cash flow yield basis. So again, it's presenting a good opportunity. Now, 4% is really good, and the company cannot really do a lot of mergers and acquisitions, and they can't really invest a lot in themselves because they have the business. It's really hard to improve the business even further. So what they try to do is they try to distribute it 100% to shareholders through buybacks and dividends. Visa mainly do a lot of buybacks, and this is why their shares outstanding have decreased a lot over the last few years, and they have a dividend, but it's a really tiny dividend. Now, looking at the valuation, again, it's much better than where it was before. Visa right now is trading at about 23 times earnings. The average was 28 times forward. It traded as high as 38 times earnings, and today you could buy the stock for about 23 times earnings. So you could say a lot of the risks have been somewhat priced in the company. Now, for my valuation model, I put in the current earnings per share of 1147, and I use 12% in earnings per share growth, even though Visa has been growing 13, 14, 15%. But the analysts have 12 to 13. I like being conservative, so I kept it at an even 12%. The current trailing PE ratio is 28 times. So I kept it the same at 28 times, and I put in a tiny dividend. All in all, I'm getting about 93% on the upside, with about a 14.3% annual return on an amazing company like Visa. And again, that's not including if the company grows a little bit more than 12 or 13%. And that's not including a potential multiple expansion from 28 times back to 32, 33 times, which is the average trailing PE for a company like Visa. So I believe Visa over here is undervalued, especially on a relative basis to all the stocks that have gone up. And I really like the stock very much. Now, the second one, which is much more hated than Visa, is actually Uber. And Uber is a stock that I haven't talked about it in a while. I've been selling some put options on the company. It has been pretty much flat over the last year, and it's still down about 13% year to date. Uber has been an absolute beast. They grew gross bookings about 22% year on year, massive gross booking growth. The mobility business is still growing 19% year on year and has been reaccelerating over the last few quarters. The delivery business has been absolutely amazing. It's growing 29% in revenues. 29%, which has accelerated from 27, 23, 22, and 20. That just doesn't happen very often. And especially if you look at the stock, you're like, this company is declining in revenues, but the company is putting up amazing, amazing revenue numbers. And I believe it's really misunderstood over here. But the best part of it all is Uber's monthly active people, which is about 200 million. So 200 million people are on the Uber ecosystems that use Uber pretty much every single day, or you could say every single month. 200 million people. That's a lot of people for Uber. Now, Uber very recently has been doing a lot of acquisitions. One of them is a parking company called Spot Hero. And this way you could book the parking and your Uber. You could book them kind of all together. If you want to do something else within Uber, you could do it all in one platform. And that could really make the company more vertically integrated. Another acquisition that they did, which was much better than this one, is the Blacklane acquisition, which is more around, you could say, luxury traveling, where you could book a chauffeur in the Mercedes and they pick you up and you pay much more than you pay for a regular Uber ride. So I believe that was a great acquisition. It could expand the company's offering into higher end, higher margin luxury traveling, which I noticed has been becoming more and more of a trend. Now, the biggest concern for Uber, and this is the reason why it's going down, is Tesla and autonomous vehicles. If you look at the Tesla rides based on this image, it's about $1.49. If you compare it to Uber, Uber is at $21.20 for this exact same ride. And that's getting a lot of attention that, companies like Tesla are much cheaper than Uber, and therefore they're going to take Uber's lunch. Now, we have to understand a few things. The first one is this is an introductory offer from Tesla. So, because Tesla is trying to expand in this region, they have the right at $1.49 or whatever it is. But for the future, they're not going to always keep it at $1.49. It's going to be a little bit higher if Tesla wants to somewhat make a profit on this one. It's even actually $4.57, not $1.49, versus $18 for Uber. So this is still about a $12 difference. But this is an introductory offer, and it's not really sustainable, especially if you compare Uber versus Tesla, where Tesla's operating profits have been plummeting, and Uber's operating profit have now exceeded the amount that Tesla generates overall, and the company is much smaller in market cap. And if they want to sustain any kind of promotions, I believe Uber could sustain much better promotions than Tesla can sustain them. Now, Uber is not just looking at the autonomous vehicle space and doing nothing. They're partnering with companies like Rivian to deploy up to 50,000 fully autonomous robo-taxis, and Uber will invest about $1.2 billion in the company. Rivian is going to start with a smaller investment, I believe 300 million, and they're going to be investing more and more based on the milestones, and they can use the money and do the vehicle. They also have a partnership with NVIDIA, which not a lot of people talk about, where NVIDIA is trying to launch on 28 markets by 2028, like a fully autonomous robo-taxi that's based on the NVIDIA platform. They're targeting 100,000 level 4 autonomous vehicles. And companies like BYD and Nissan will be the ones that are building the cars using NVIDIA's system, and Uber will be more of a data provider, and they will collect recurring revenue on the data, and they will also collect fees because those cars will be listed on the Uber platform. And again, the company is doing so many things, but the market is still not realizing the value. And the question that a lot of people ask is, why would you pay Uber as a middleman if a company like Tesla and Waymo, they can launch their own app? They don't really need Uber. Well, we've seen Waymo, they've been partnering with Uber and partnering even with Lyft recently in many different markets, even though Waymo could do it themselves, and they're doing it themselves in some places, but the Uber platforms offers much more benefits than for a company, let's say, going on their own. Now, for example, with Uber, they can get you about 20% more in utilization. Okay, the take rate's about 15%. So if you're getting 20% more in utilization, you have your car on Uber platform, and you're making $102 instead of $100. So pretty much almost making the same thing, but you are on the Uber platform, and you get so many different benefits, such as demand ingression, routing and pricing, payment-related stuff, fraud, customer service, fleet tools. They also have a fleet management system where they manage the fleet, and you could say they clean the car and they charge the car, and they do all kind of things for Waymo cars that Waymo maybe does not want to do it themselves. And it's the same thing with WeRide. It's the same thing with Rivian. So there's way many competitors in the space, and Tesla is not going to have 100% market share, especially not outside the United States. So Uber is making itself as like an EV or an autonomous vehicle ecosystem where they have the joint ventures, they collect royalties on the NVIDIA cars, but they also have a management fleet platform where they maintain them, they clean them, they do all kind of things, and they have all the partnerships, and they're also invested in those companies. So I think they're doing the right things. They're gonna have a really good position as they're being hands-on on those. They're not just counting on the Waymo partnerships. They're investing in Rivian, they're investing in WeRide, taking a stake in those companies, and kind of forcing them to be partners with Uber. So I think this is really, really amazing, and I think it's being misunderstood by the market. Now, for a company that's growing 26, 27% in deliveries and revenues is still growing 19%. What do you believe the cash flow multiple is on such a business? I would say 25 to 30 times cash flow. Well, it's not even close. Uber is trading at about 21 times cash flow. 21 times cash flow for such a business. I think it's really, really undervalued. The cash flow is expected to grow like 6% this year, 17% and 11%. I'm personally not seeing it. The company has always been beating the expectations. I would not be surprised if they grow 15 to 20% in free cash flow over the next 3 years. And therefore, I would expect the stock to deliver a 15 to 20% annual return. And this is, of course, excluding any multiple expansion. And this is excluding all the buybacks that they could use from the free cash flow to do buybacks on the company. And they've been buying back a lot of stock. So I believe Uber is undervalued, is much more undervalued than Visa, to be honest. Visa is a much safer bet, you could say. It's just an amazing company. Uber is a little bit riskier, but it has more risk but more reward. And that was my opinion on those two stocks. Hope you enjoyed it. It was not financial advice. If you did enjoy it, please press the like button and maybe consider subscribing. So I'll talk to you in another video.